nobody knows 5 years or 10 years out. And if the founder thinks they know what's going to happen 10 years out, they're fooling themselves. And as operators, we've been through this and we've lived this. So we're not actually asking them for a financial model. We want the financial model to be in the data room, and we never look at it because it's all garbage, right? Just assumptions on paper. What we want to see at this stage is the way the founding team thinks about the problem, how their product roadmap evolves, how they're thinking about product market fit. It's really important at that early stage that you're not only chasing revenue as product market fit, but you're chasing the right type of revenue that drives a different understanding or a better understanding of your business.
Welcome. Today on the show, we have Anay Shah, the founder of Stepchange Ventures, and he is about as focused of a VC founder that I've run across. Not only has he gone and picked a niche, he's gone and picked a niche within the niche I didn't know existed before we went and saw that Anay was able to join us on the show. So on that note, I'm going to pass it over to you, Anay, to just give some context, some background, and just a bit of the origin story on how you've gone and launched a clean tech / climate software fund, because it's going to be a catalyst just to venture capital philosophy and other questions that I have for you today. Take it away.
Wonderful. Good to meet you, Edgar. Happy to be on this, and congrats on the launch of Raise&Exit. My name is Anay Shah. I'm the co-founder and GP at Stepchange, and we are operators turned investors. And we'll get into the fun thesis around climate tech and energy solutions investing in early stage companies. By way of brief background, spent most of the last 20 years helping build 3 different startups globally. Started off my career at the State Department doing emerging markets, poverty alleviation work generally, and then moved to India and helped build an off-grid solar company called D-Light, and then spent the last decade building 2 global fintechs. And first building 2 global fintech startups. First one, international payments. I was an early employee at Remitly. We grew from 9 people to 400 people on a early, hyper growth journey, and IPO'd a couple years ago. And then spent the last 5 years as an exec at Tala, kind of a later stage digital banking company. And my first love has been and will be kind of climate and sustainability. I was getting a dual degree at Stanford, my MBA, and a master's in energy, which I ended up dropping. But when I had the opportunity a couple of years ago to pick my head up and take a step back and say, do I want to keep doing financial inclusion and fintech work? It was obvious to me that I needed to come back to broadly to climate. And so that's a little bit of how I got to then the point in time in 2023 where I was like, I want to have an impact in this ecosystem. What can I do with my limited experience and expertise? And the idea was not to go and start an early stage VC fund, particularly in 2023, post zero interest rate environment in a market that is very much kind of gone through its fair share of roller coasters. But I met my co-founder Ben, and we saw an opportunity because we both loved working with early stage founders. And the VC was kind of our means to have an impact. And so I'll get into a little bit of the thesis there, but the origin story is operators turned investors launching their first fund in particularly a unique asset class. Was not by design, but more just kind of what the universe kind of had in store for us.
That's awesome. And the theme of our podcast is really to help founders to go and figure out how to raise and just prepare themselves for it. So there's something in kind of what you're pointing to here as well, which is around the fact that, look, you have focus on your fund, right? And there are funds that are generalist funds. There are funds that are specialized funds. What would you say has been your experience in how you may do due diligence differently? Like how would somebody who is like, hey, I have a very clear value proposition that would suit your fund, would you say your due diligence would be different because it's a match of offer to capital from somebody who would be from a climate tech offer to a generalist fund capital? What would you be doing differently?
That's a good question. So by way of context, we invest in early stage climate tech solutions with a focus on software enabled technologies. So what that means is, there's a phenomenon happening to the physical world, which is the changing climate. That creates an arbitrage opportunity and a behavior change for governments enterprises and consumers. We're basically taking a scientific and technical lens to that behavior change and
Yeah.
saying we can find outsized opportunities given what's happening in the broad ecosystem. And so by some definitions and by some understandings, we're actually operating in a very large definition, a fairly wide aperture, because you could make the argument that any part of our economy is being affected by climate, and therefore a solution that addresses an enterprise's problems would be fair game. And the narrowing of the funnel is we focus on software-enabled solutions instead of deep tech and hard tech, and I can talk a little bit about why. But that's just a little bit of the framing. And then to your question on like how is our diligence different? I think we as a fund operate on a dual mandate. And so, we are a VC firm. We have 105 LPs that have taken a portion of their assets to invest in this asset class. It's classic VC. It's illiquid for 10 to 12 years, and they're looking for outsized 5x returns. So we've got to invest in companies that are venture scalable and will be that billion-dollar exit. What we do on top of that is, as a thesis-driven fund, we have to demonstrate to ourselves and by proxy to our investors that this does have a direct impact on mitigating greenhouse gas emissions or helping us adapt and be more resilient to climate change. And so we do underwrite business against that as well.
You just said something just really interesting in that part, right? Which is like, I don't know, sometimes we kind of abstract the whole act of capital raising, right? And we sometimes even abstract the notion of like starting a company. But what you're just talking about is like that real world experience, and that it's almost like you have a consortium of 105 people that are there on a real world impact, and it needs to have financial materiality. And I think this is very different from and I went and co-founded an NGO with X sum of millions to be able to deploy to initiatives. This is around commercialization scale. And what it brings me to is, look, I still feel that capitalism is the basis for having the greatest impact. You can do some really bad things with capitalism, but I still look at it like that basis is there. And I think what you're pointing to is, and maybe I'm putting words in your mouth, but it's like if I'm coming to Stepchange, I need to be coming with a commercially scalable idea. Tell me a bit more of how that changes what you say yes or no to between commercially scalable versus a good way of helping the climate.
Yeah, this is a great point because unequivocally, we're investing in market-ready solutions at commercial scale that can be multi-billion-dollar enterprises. That is fundamental to the thesis. And I think the interesting thing here is some people may see that at odds or at tension with if you're investing in climate tech solutions or in energy. And we don't see this dual mandate as creating a tension. In fact, the companies that have the potential to be a multi-billion-dollar company and are providing a technology that helps decarbonize the economy, those two go hand in hand, because you won't actually drive the impact we want unless you're commercially viable and sustainable. And so the two for us are we have to underwrite against both. And so we do end up passing on companies that check one box but not the other.
Oh, that's so good. That's so good. Because
Right?
I'm gonna kind of go into like a question that I have for you, which is, what do you do in that situation, and how does a founder looking to raise, like, balance themselves? Like, what should they be asking you when they go and say, hey, we actually, like, it's not a fit, right? Like, you have a good business, it's not a fit for our fund. How should a founder take that not as a rejection, but as a reinforcement? Because I hear that a lot. Oh, the fund said no. And I'm like, did you take another action? They're like, what do you mean? Well, did they like the business idea and it just wasn't a match for their investment thesis? Because those are two different things, right? You can be a fan of a business idea, but it just doesn't match what your mandate is. So tell me a bit more about how founders should account for that as part of fundraising.
I think it's huge. And there's something that you mentioned there that's important that a lot of founders don't do, which is, if there's a VC that's passing on them, it's like, okay, cross them off the list, move on. They're dejected, but they're focused on it. And I actually think there's a lot of value lost, because when we go in and meet a founder and we go into diligence and we end up passing, we actually take quite a bit of time to articulate why we're passing on them. Because at the end of the day, we want the founders we meet to succeed, and particularly because we're investing in energy and climate, we know it's an all hands on deck situation. And so even if you're not a good fit for us based on our diligence, we still want you to succeed. And so we actually take the time and have that conversation, provide a lot of feedback. I think there's a you're not a fit for our fund can be kind of a cop out for a VC, frankly. And we try not to fall into that trap. For us, that not a fit could be, hey, we do not see the venture scale returns here. That's really important feedback for our founder, no matter who they're raising from, because that means that they either have to adjust their business model and their pitch to raise from this asset class of venture, or they have to go find a different type of capital, right? So I think that's critical.
So perfect what you went and said that. It's a different type of capital, right? Like I think it's that dramatization of venture as the sole path. And I think what you're pointing to is it is a path. And this is the cost of entry to be accepted in that path, as an example from your fund, or it could be from a different fund. But it's like you can't put all your eggs into the VC basket, I think is what I'm also hearing you say.
Absolutely. I can't tell you how many times we have that conversation with the founder. We're like, we can pencil this business out to 25, 50 million in ARR. And we can see 70, 80% gross margins. This is a fantastic business. But unless you can demonstrate a product roadmap and a vision that gets you to 100, 500 million in ARR, it's not venture scale. And so you should really think hard about, do you want to raise this type of capital, which will limit your options because it puts you on a path towards a certain type of business? Or are you totally happy creating a very profitable lifestyle business that will create generational wealth for your children, but is not venture scale? And is there a different type of capital there? We run into that all the time.
That is really cool. And what you've actually kind of pointed to is another critical element that's here, which is how much do you need to go and have the business of your early stage company figured out 5-10 years out versus understanding that there's a path to a business 5-10 years out. So maybe that's like a good question for you, because you focus on pre-seed and seed. And tell me just like, what is that nuance that people should actually consider at pre-seed versus seed when they're trying to go and raise capital? Because I think sometimes people just generalize raising capital and they may not sufficiently appreciate, like, don't bother going to a fund that's not going to cut a check before Series A. Mm-hmm. How can they distinguish themselves at pre-seed versus seed? What would you say are the top things to look for?
It's a great question. I mean, if you think about fundraising and capital stage on a spectrum, I think about like kind of you're going to need to present and kind of check the boxes on all 5 to 10 dimensions of VC diligence, but the weighting is different. And so at pre-seed, obviously the weighting is much more, people product, team TAM. It's does this founding team have the right pedigree, the experience, not pedigree, but the founder market fit, the expertise, the vision. And that's a larger weighting than at seed or Series A, where you're looking for revenue traction, you're interrogating the customer profile, you're looking at product market fit. But I think at either stage, nobody knows 5 years or 10 years out. And if the founder thinks they know what's going to happen 10 years out, they're fooling themselves. And as operators, we've been through this and we've lived this. So we're not actually asking them for a financial model. Well, we want the financial model to be in the data room, and we never look at it because it's all garbage, right? It's just assumptions on paper. What we want to see at this stage is the way the founding team thinks about the problem, the way they have designed their phase 1, phase 2, phase 3, how their product roadmap evolves, how they're thinking about product market fit. Do they understand go to market and have a hypothesis driven approach to testing which methods of distribution? And at pre-seed, it's much more of that, like we can see the founder market fit. We see the market opportunity there. They've nailed something in terms of the market they're operating in. And the way they think about the problem and the way they're going to build the team to go and address that is something we believe in. At seed, and the market is changing, right? Particularly because every company right now has some component of AI to it, and that's driving valuation.
Preempted a question. I love it. Keep going.
But it's driving valuation expectations, and so the traction that you expect at seed with a little bit more fidelity on who the customer is and how you're going about distribution is that much higher. And you're basically doing the math to saying, what does this company need to get to Series A, and how certain is that? Obviously, team and people matter a ton at seed, but it's been a little more de-risked because they have revenue.
I love what you kind of go and say there. I want to go back to like one thing that you said before around, look, you're not really needing the financials and the forecast, but I think what you're pointing to is you still need to be able to understand the notion of the go-to-market, right? Like a lot of the earlier stage companies that I work with, I'm like, look, you don't need to go and have your forecast sketched out. You need to be able to go and articulate that you understand the unit economics of scaling so that as you get new signal, you know what to adjust in your forecast to demonstrate what that revenue pathway is, and that you're able to understand the relationship between price and value once you're a revenue generating company. And I think that is often, I think, what is missed. People are like, hey, I have a technology solution, I have a software solution. I'm like, that's great. What's the commercial scalable element that you're trying to go and convey? So that to me is like a really interesting point that you're making, which is, don't give me beautiful forecasts. Tell me you understand how to change the forecast.
So you said it perfectly. And to me, that forecast is actually a strategy document,
Yes.
not a financial document.
That's such a good way of summarizing the forecast as a strategy document. That's so
Right?
good. I love it. I love it.
These are the levers of my business, and this is how, when I move these levers, what it does to my business. And
Yeah.
therefore, I understand where there's leverage, and I understand what to focus on. Do I need to reduce costs here at scale? Do I need to grow margins? Do I understand unit economics? How is top line going to grow? It's all insights into your strategy.
So let me ask a question then on that part, right? Because I see these lovely pie charts at times coming out. I'm like, I'm going to take your $1 million and a percentage is going to go here, percentage is going to go there. But what I'm actually kind of going and hearing is, how are you able to go and gear my $1 million based on capital allocation? Right? Like that to me, I think is actually the better question here, right? It's that finance is a strategy. It's capital allocation strategy.
Exactly.
Right? And what I'm hearing at pre-seed is, how do I get to sustainable revenue? But then tell me how you would view that capital allocation differently when you're at a seed investment due diligence. What are you looking for there? Because they've gotten to revenue. Now it's what?
Yeah. So I think pre-seed to seed, if we were to kind of create some boundaries there, would be, I have a hypothesis-driven roadmap that I'm raising capital against to go and find product market fit. And that is my singular focus. And I need to hire some team to build out some tech to support that. But my maniacal focus is on finding early product market fit. And that gets me to seed, initial customers, and revenue. Then roughly at the seed stage, you're saying, hey, I've found something here. This is my initial wedge. I'm raising capital, pour gas on the fire. I want to build team. I want to enhance the product. I want to chase this customer pipeline, and I want to 5x revenue, so that when I'm ready to go to Series A, I've got a sustainable recurring revenue base with a couple of customer profiles, and I understand the adjacent products and the adjacent distribution channels to go and multiply that.
This is so good. So I'm looking at, you said like the founder fit, that's there, right? Like, do they have attraction? But like what you just went to put there is like, I'm looking for product market fit. And I almost wonder whether like some of these pitch decks are almost like too complicated, which is, hey, we need a check. We have this hypothesis. We're looking for traction. Here's the basis of the hypothesis. We're going to spend this money to get to product market fit, which is going to get to revenue. Next stage is scaling capital fit. Can I at seed go and scale this capital into revenue at a more efficient ratio than it took for me to get to where I am today? Like, that's what I'm hearing, what you're going and saying. And I think it's like, I'm trying to get this stuff to a level of simplicity that I find is sometimes either too abstracted, but I'm trying to bring it back to that reality. So that's like, I'm really kind of picking that up from you, because I now understand why you're not doing Series A, because that is a completely different level of complexity. You have to assess that as a business versus as a concept. So
Absolutely. I think you said that very well. And there's 2 points I'll make. One is on that pre-seed, seed to Series A. I find myself talking to founders, and the revenue metric that they're looking for is like, hey, I want to hit 500K in ARR by this point. This is when I do this. And I think that's very important, particularly in this macro environment. You have to have a monetization strategy, but it's quality of revenue, not just quantity of revenue, right? You can get early revenue, but that doesn't mean that you've unlocked an understanding and a signal. You can have lower revenue that's higher quality because now you've tapped into a customer base that's got a massive pipeline opportunity and kind of adjacent growth. And so it's really important at that early stage that you're not only chasing revenue as product market fit, but you're chasing the right type of revenue that drives a different understanding or a better understanding of your business.
Oh, it's so good. And what you're kind of also pointing to me for me here is like I try and get a lot of founders to understand the other side of the equation, like hence why we launched the podcast, right? But one of the things that is just there, like I like my brain is still rattling off the fact that you have 105 LPs in what you're doing. And what's very interesting for me is that, hey, I just got funded by Stepchange. What this is telling me is that I actually have by proxy 150 people that are willing to go along with my idea to see if it can get traction in the world. And I really want to kind of emphasize that element to founders, that it's an ecosystem that you're stepping into when you go and get capital. But tell me maybe a bit on that personal side of what it was for you to get 105 LPs to go and say, hey, we're going to trust that you're going to make enough right bets. And let's be really honest, some of these pre-seed and seed bets, they're not going to go anywhere, right? And it's not a judgment on the founders, right? We're all trying to find this traction. But give me a bit of that human component of what's there on the other side of who cut that check so that you can cut a check.
Whew. We could talk about this for multiple episodes. It's been a journey. So we, as I mentioned, Ben and I are both operators turned investors. We had LP'd in funds. We have our own angel portfolio, but this was our first time managing other people's capital and becoming an institutional investor. And a lot of that fund one emerging manager that doesn't have the massive track record to bet against, you're betting on us, right? You're betting on our ability to find great companies, to diligence great companies, to secure allocation in those, to support those, and then to grow. And I think a lot of it is based on the fact that we've been moderately successful in our own careers building, scaling, and selling software companies. And I think one of the smartest things we did was we have a clear thesis and a vision that we were raising against. We did a fairly early first close amongst the kind of initial couple $1 million of capital that we secured, and we started actually investing while we were fundraising. And that both helped sharpen our understanding of our thesis. It helped build our brand and launch us in the market. But it gave investors something tangible to look at, so that they weren't just thinking about kind of the slide deck and the vision and what we were saying, but they had examples. And then the other piece of that puzzle was what we wanted, why we set out to say, hey, we're not just looking for a very small, tight-knit group of investors. We actually want to broaden this for a couple different reasons. Number one, we're investing in climate tech. And this is something where we need to create a big tent and bring outside capital in, because the problem is so large. So we wanted to expose this to people who were first-time investors, who were not VC investors, who were not climate experts, as well as those that were already on the train. And the second point was that we saw, you mentioned you're not just investing. It's not just the two of us investing, but it's a community. It's an ecosystem. We actually feel like this is a huge advantage for founders, and then there by proxy the portfolio performance, which is we've got a community. All of our LPs have come on board. They're product leaders, they're founders, they're operators of large tech companies inside and outside of energy, and they're ready to kind of roll up their sleeves and provide a little bit back to the founders beyond their LP check. And so now we're amplifying our ability to help the founders, and it creates a little bit of hopefully differentiated capital and differentiated value prop for us. But a big part of this was creating a community, because again, we feel like we need to bring more people into this opportunity to realize the results that we all need.
It's so good what you go and say there, because I think in that pre-seed and seed domain, right? Like this is like like mission. I almost feel is starting to be overused as a word, but it is conviction driven, right? These are people who are willing to also kind of go above and beyond the cash. And I think if I kind of put on like the due diligence that founders or would be doing in speaking with VCs is like beyond cutting a check, what else am I getting access to? And I love what you're kind of pointing to there. To kind of like close out the podcast, I want to bring something back that you actually just said at the very beginning of the podcast today, which is I would say the reality check that you're operating under, which I think sometimes is forgotten by founders, and I've been guilty of it myself, so totally outing myself here. But it's that time frame, right? And you said you know you're going in for 10 to 12 years, and I think one of the things that I try and kind of convey to people is look, there is no overnight success. Every goddamn overnight success has been 10 years in the making. I think you've started that fund with that basis. How do you think that is a filter on strong founders? How do you account for that when you're doing your due diligence, that they have that constitution to take this thing to a 10 to 12 year timeline to be overnight successes?
That's interesting, because I think when we were prepping, you had mentioned kind of what's a part of your framework that you think is undervalued or overlooked in this industry. And then I don't know if it is, but it's exactly this point, which is at pre-seed and seed and early stages, it's people, market, product, right? And it's so heavily weighted on that founding team. And you're looking at background, you're looking at expertise, you're looking at insight, founder market fit, all of that. I think it's this point that actually we spend the tail end of our diligence typically really drilling in on, which is, what's your personal motivation? What's your personal situation? How are you thinking about this as an individual, a leader who has multiple opportunities in front of them, because these founders are incredibly brilliant and can go off and make easy big money at a big tech company or something else. Why are you personally putting it all on the line? And if you have a family, how are they thinking about this? How are they behind you? Are you going to move countries or states to pursue this? We really want to understand that personal motivation, because again, we've lived it. And we understand that it is second marriage. If you're going to go and build this company, you have got to be obsessed with this problem, and you've got to be intrinsically motivated to be obsessed with this problem for a decade. If you're extrinsically motivated, it's my personal belief that flame's going to burn out, because there isn't any amount of extrinsic motivation that can sustain you through all the ups and downs that you're going to face as a founder. You've got to have some other drive, and you've got to have that supporting cast, us as your investors, but your family, your friends, your children, your community, whatever it is, behind you. And figuring out if they're in it for the right reasons, I think helps give us a signal on whether they're going to really endure the grind that they're putting themselves through.
Like, pardon the pun, but you're planting the seeds for so many follow-up conversations in a future podcast. I'd like to thank you for joining us today. And I have so many questions for you at a future round, and I think I'm going to harass you on that one. Thank you for joining us today. My pleasure.
Thank you, Edgar.
Cheers. My interview with Anay Shah was such a energetic one. I just love his vibrancy and energy. And for somebody to go through being in a bunch of scale-ups and getting so much learning, and then going and saying, I want to go back to why I kind of pursued the educational or career or volunteerism or mission-driven paths in my life. And it's a different type of person to go and have on your team. And what he just reinstated for me is that criticalness that is there in matching the investor with the founder. And to look at the fact that he had so many people who bought into his vision in cutting a check into his first fund is an expression of the fact of the buy-in that he'd be bringing into the types of companies that he's investing, including possibly yours. So why is this such a critical part of Raise and Exit? It goes back to the theme that I go and have around how do you go and find the right fit for you as a venture capital partner. And what I really like that Anay talked about is the fact that it's not just going and having a good idea. It's having a good idea that is scalable at the level of a venture investor. And this goes back to, why are you trying to go and get money, and who's that fit to get money from? And in his base, it's venture scale, and it has to be scale. There still needs to be a critical business outcome that is out of here. Maybe not at the craziness that you see in the AI universe today, but you still need to be able to demonstrate that there is a potential for the business to be a 10x or 100x version of the underlying component that is there. And that is something that not enough founders go and take a look at. They kind of get into this trap of wanting to go and solve for the issue, but you also need to solve for the consequence of solving the issue. And that, I think, is something that I got from Anay and speaking with him, which is so important, is that you cannot just go and start a business. You need to go and start a business that understands how it's going to evolve as a business, even if it doesn't follow that pathway. And the closer you are to the alignment of why you have the investors cutting money for you, the more you are able to go and articulate to them how they're going to go and benefit from your adaptability in the future that is there. Good luck. Cheers.